Globally, the housing crisis impacts over 1 billion people. In Kenya, the math is particularly stark. The country faces an acute shortage, requiring 250,000 new housing units every single year. To address a gap of this scale, the government launched the Affordable Housing Program. The objective is to replace sprawling informal settlements with permanent infrastructure and secure living conditions. For a citizen to access one of these new apartments, they must first register through a national digital portal called Nyumba Yangu. The system categorizes applicants by income level. This strict segmentation is designed to prevent wealthier buyers from taking up the stock intended for low-income families. The most critical target is the social housing tier. This category is explicitly reserved for individuals earning 20,000 shillings or less per month. This demographic operates largely outside the formal banking system. Their financial history isn't found in bank ledgers, but on feature phones and mobile money platforms like M-Pesa. While a digital registration creates a place in line, a profile on a phone cannot build a house. Real ownership requires upfront capital. Take, for example, a woman running a vegetable stall in an informal market, trying to support her family on a tight daily margin. Under the social housing tier, a studio apartment is priced at roughly 640,000 shillings. Historically, affordable housing projects have failed at the point of entry because of one specific requirement: a mandatory 10% upfront deposit. For a 640,000 shilling unit, a 10% deposit requires 64,000 shillings. When a 20,000 shilling income is split between rent and survival, saving is impossible. Expenses leave zero margin. The broader market math is even steeper. This calculator shows that a 3 million shilling home requires a 300,000 shilling deposit, a structure that inherently favors those who already have wealth. The entry fee required to access affordable housing effectively locks out the very people the program was built to serve. This creates a macroeconomic dilemma. How does a state fund housing for millions of citizens who cannot afford the entry fee? The government's answer was the Affordable Housing Act of 2024. The core of the act is a mandatory 1.5% housing levy. This levy is universal, deducted from the gross income of both salaried and non-salaried workers, and matched shilling for shilling by employers. These millions of individual micro-deductions are pooled into a centralized affordable housing fund. By creating this fund, the state bypasses the need for commercial bank loans, financing construction and mortgages directly through the board. The universal levy takes the financial limitation of the individual and turns it into the collective purchasing power of the state. With a capitalized fund in place, the government could legally rewrite the rules of market entry. The first major change came in 2025, when regulations officially slashed the mandatory deposit for all units from 10% down to 5%. But for a vendor in the social housing tier, even a 5% deposit is a wall. To bridge that final gap, Regulation 3 introduced a mechanism known as deposit assistance. This allows the state to directly cover the deposit for those earning under 20,000 shillings, effectively removing the cash upfront requirement for the most vulnerable applicants. When the state assumes the burden of the upfront deposit, the primary financial obstacle to home ownership suddenly disappears. By absorbing this initial risk, the state ensures that a lack of liquid cash is no longer a barrier to a dignified home. Once an applicant gets through the door with deposit assistance, the balance is financed for the long term. Through the tenant-purchase scheme, buyers pay off their homes over 25 to 30 years at subsidized interest rates between 3 and 5%. While market rates are much higher, the subsidized math for a social housing studio brings the monthly payment down to just 3,900 shillings. This graphic compares that payment to the high rents citizens currently pay for unstable housing in informal settlements. Instead of that money disappearing to a landlord every month, these payments now actively build generational equity. Ultimately, this innovative system creates a direct, reliable line from a simple mobile money account to real, physical homeownership. Kenya's framework proves that when a national levy is paired with targeted assistance, a digital registration can finally become a permanent home.